So without any further ado, we are going to get started. Rob, thank you for joining us.
Thank you for having me, Kathleen. Thank you for your comments.
What a week it has been. And this is a sophisticated audience. It has not just been a bond rally.
Yeah.
It has been a bond stampede. Yeah. It has not only been in the U.S., it has been around the world. What's driving it? Is there a message here, a signal for the Fed?
Well, the yield curve and bond yields globally really are indicative of skepticism about the prospects for future growth. European growth is slowing, Germany, Italy. China, although may appear to be stabilizing, but their underlying growth has been sluggish. And the prospects for U.S. growth are a little bit more sluggish in 2019 than they were in 2018. We've been expecting all through 2018 the growth would slow. It's now happening. We're not sure how much. I'm not sure how much growth is going to slow, although my best judgment is we're going to slow down to 1 3/4 to 2% growth. But I think the bond market's suggesting that it could be a little worse than that. We'll have to see. But that's really what you're seeing in the bond market is skepticism and sluggish expectations for future growth.
Well, it's interesting, Rob, that this bond rally really seemed to get started after the FOMC met and took all the 2019 rate hikes off the table. Moves can be in either direction. The bond market has increasingly now started pricing in the chance of at least one rate hike this year. Is that a possibility, or is the bond market getting ahead of the Fed?
Yeah, and I'd emphasize, I'll give you my own view. I didn't, in my dot plot, and I've been saying this for some time, I didn't have any rate increases for 2019. It doesn't mean that I couldn't change my mind. It means as I sat there in the March meeting, that was my base case for 2019, but it's always subject to change. And so what my main goal is for monetary policy right now, and the stance of policy, is that we're flexible and that we are patient, and that I want to see how growth is going to unfold for the next several months in 2019. And based on what I see, and for me, I look not only at the economy hard data, I look at corporate earnings reports, I look at a whole range of factors, I look at what's going on in the markets, particularly the fixed income markets and the treasury curve. And based on all that, as we get through later in the second quarter, I want to be flexible enough and have a stance, a policy, where we can move appropriately. I don't know where that will be yet. Could be no action at all, but I think we're well positioned right now to take the appropriate move based on how the facts unfold.
What would be a trigger for you to say, looks like maybe it's time to think about cutting rates and maybe even pull that trigger?
So for starters, I've said our base case at the Dallas Fed is that GDP growth for this year is going to be a little bit below 2%, in the neighborhood of 2%. And I have some confidence because we were saying all through 2018 that we thought growth in 19 was going to slow meaningfully. It's turned out to be a little slower than we thought in 19, but if there was evidence to suggest that growth would actually undershoot that forecast, and there's a number of uncertainties. Fiscal stimulus is waning. We've got all this trade uncertainty. We've got European growth decelerating. We've got issues with China. We've got a long list of uncertainties. If I saw growth, if I started to believe the growth prospects were going to be below that base case forecast, then I'd start thinking about what does that tell me about the stance of policy. In talking to me, what I've been saying for the last couple of years is I don't think the Fed should be restrictive in monetary policy in our stance, but I also felt we're getting to the point through 2018 and even up to now, I'm not sure we need to be accommodative either. I would say our stance right now is that we are just mildly accommodative. We're in the neighborhood of neutral. Neutral is an amorphous concept. It's uncertain. And so if I saw some slowing beyond our base case, which told me maybe we have a tighter policy than I thought, that would get me to say, let's revisit policy. And in that regard, the yield curve is one of several indicators I'll look at making that judgment.
So you are watching it closely. It did invert the 3-month bill to 10-year note, which is the Fed's favorite usually. Many Fed officials say that.
I'll comment on that.
Okay. It has uninverted just a little bit. But bottom line, it's very flat, whatever curve you look at. How strong of a signal is that? And let me just add that of all 7 recessions in a row foreshadowed or at least preceded by an inverted curve.
Right.
One time the curve inverted and it didn't cause a recession, but that was back in the early 60s when the Fed started cutting rates aggressively, preemptively. And I think that's the question for the Fed as it looks at these curves.
So I've been someone who's said all along, an inverted curve of some magnitude and or some duration, I think is significant and something I'll watch. We don't have either yet, by the way. So just to remind people, the 3-month T-bill versus the 10-year is basically flat, 240s versus 240s. The 2-year is around 220, and so that 2 years to 2s to 10s are upwardly sloping. I think the part that is inverted is the 3-month to the 2-year and the 3-month to the 5-year. I pay attention to that. But in particular, I would need to see an inversion of some magnitude and or some duration. A few basis points one way or another, or something that moves for a few weeks is not the trigger that I'm looking for. And here's the reason. Here's the reason why. The reason, it's very important to talk about the reason I think the inversion matters. For me, the signaling is less significant because there's a lot of changes in the world, including lots of global liquidity. The thing that is significant is what a meaningfully inverted curve does to credit creation. Mm-hmm. That's why I'm interested in this. And in particular, if you can't borrow short and lend long and make a spread, or if the curve gets where you're paying more to borrow short and you're getting less to lend long, it historically has meant, and I think it would mean, that it would create some impediments for credit creation. There's a reason normally these recessions happen with a lag after the inversion. It's because I think credit creation starts to get impeded. Mm-hmm. And we know if credit creation and financial conditions tighten because of it, that would lead to a slowing. But that's the reason I'm interested in inversion. A flat curve in and of itself, or flat-ish, which is I think what we have right now, may not necessarily be that significant. So what I'm watching for is, again, an inversion of some magnitude and some duration.
Okay. Inflation might have something to do with what bonds have been doing,
yes,
with what the curve has been doing.
Yes.
And we got some very interesting data on inflation today because we see the Fed's main measure. They look at the headline on the PCE deflator. They look at the core, which takes out food and energy. Now, the core, which has been pretty much close to 2, is back down to 1.8. The headline has fallen to 1.4. And is there a concern at the Fed that it has not yet sustainably reached that 2% level? And is that another thing that inclines the Fed, if anything, not towards hikes, but eventually some more ease?
So I'm one, as you know, who's been very vocal about why we might be running behind our 2% target. And I've also been vocal that I don't think inflation's running away from us. And I've also said, and I'll say it again today, with 3% growth last year and this tight labor market, if we're struggling to muster inflation even at 2%, it tells me that if we slow, you could have some deflation, or have inflation readings that are even further behind 2%. Now, why is that? Some people say because there's more slack in the labor market than we might have thought. That's possible. Second, maybe inflation expectations have broken down a little bit. That may be a factor. For me, the third factor is significant, and we spend a lot of time on this, and we do conferences on it at the Dallas Fed, including one in May. For me, technology-enabled disruption and the structural changes in pricing for businesses is not talked about enough. And what do I mean by that? All of you live it in your lives. Businesses have less pricing power today than any time in my lifetime. Why? Consumers, all of you and all of us, have in the palm of our hands more computing power than most companies had just 15 years ago. We take it for granted, but that's a big deal. So what happens is consumers are able to shop for the lowest price using technology. And so in addition, what companies are doing, investing more in technology in order to address their lack of pricing power. And in addition, new models. Think Lyft, think Uber, think Airbnb. You can go through the whole Amazon, obviously. New models are being developed that are disrupting old models that provide lower price and greater convenience. And so you wrap all that up together, you go industry by industry, there is a lack of pricing power. It's structural. It's not cyclical. This is a structural change. And so it doesn't surprise me that these inflation readings, and I've been saying this, and we've been saying this at Dallas Fed for some number of years, we expected inflation pressures are much more muted, because if you have a cost increase, you can't necessarily pass it on to the consumer. Instead, you're more likely to have margin erosion.
So Rob, it's not, you can't get any cyclical inflation going because you've got a structural problem.
It's one of the reasons, yes.
Okay, but let me ask you this. Because if the Federal Reserve cannot get us in key gauge of inflation up to 2% and keep it there, have we seen the end of Fed rate hikes for the foreseeable future? Can you imagine the Fed hiking rates without having inflation at target?
I don't want to prejudge it yet, because a lot of this is going to be, so there's two parts of inflation for me and the way we think about it at the Dallas Fed. There's the cyclical part, and that's things like how tight is the labor market, what's GDP growth, how much will the unemployment rate, will U6, which we watch more carefully, unemployed plus discouraged workers, plus people working part-time or want to work full-time, that's now 7.3. How much tighter does that get, and how much pricing pressure does that create? And then there's the structural part, which I just talked about, which are structural impediments to more pricing. I think the cyclical pressures up through the end of 18 or third quarter of 18 were building. And I wouldn't rule out, we don't know what growth yet is going to be for 2019. And that's why before making a judgment, I just want to see how the year unfolds. The cyclical pressures haven't gone away. We have a very historically tight labor market. And if I talk to any company in my district, which is growing very fast, but through the nation, we've got a very tight labor market. I'm just cautioning, even with that cyclical tightness, you've got this structural headwind. And so I don't want to make a judgment as broad as what you were saying, but it's a factor I take into account. And in particular, it's one of the reasons why I've said for a while, we have the luxury of being patient.
Is that a yes or a no?
I wouldn't rule out what action we're going to take. So you asked, does that mean rate increases? I wouldn't prejudge that yet, and I'm not prepared to prejudge it yet. And so that means that we're just going to have to wait and see.
This is down the road, perhaps, a bit hypothetical. But let's say the Fed decides, we're going to need to cut rates. You've got dot plots. What are you going to do with dot plots when you start cutting rates? Are you going to come out of the meeting and say, consensus is for three rate cuts this year? Is that something the Federal Reserve can manage without having, either people being way too pessimistic or way too optimistic? It's very different, it seems, than suggesting what you might be doing in terms of hiking.
So just for the group here, just so you understand, the dot plot means every 3 months each of us submits, each of the Fed presidents and everyone on the Federal Open Market Committee submits our forecast for GDP growth, inflation, and as well as the path of rates. And we change it every 3 months. So it's not a commitment, it's just our snapshot at that moment in time. And so for the moment, as we said, right now, my dots were no rate increases for 19. And we'll just have to see. In June, I'll submit another dot plot. And I think the process and the structure we have will work very well. The issue which I think you're raising, how we communicate and explain what those dots mean and why it's happening, puts a real onus on the Fed at inflection points to make sure we're communicating very, very clearly. And I think that's the bigger challenge. Europe.
When we look at what caused the bond stampede over the last week or so, the thing that really threw fuel on the fire after the Fed took its 2019 hikes completely off the table, consensus, you didn't have dots, was the really negative manufacturing number out of Germany.
Yes.
And it put a big spotlight on Europe, because Europe has been showing signs of slowing, before the trade war was even getting nasty. So I think the concern now is that Europe is really weakening, and that it doesn't have much ammo to use to try to ward off something like a slowdown that could lead to a recession.
And all that, I think, is the case. And you mentioned that the curve changed, and there were these changes in the curve after the Fed meeting. What happened very shortly after the Fed meeting is these German numbers, which I think also, to your point, had a substantial effect. So the challenge, yes, for the ECB, they already have a large balance sheet. They not only buy government bonds, they've been buying corporate bonds. Something we buy treasuries and mortgage-backed securities, or we had been. at the Fed. They buy much more broadly. And so the real challenge for Europe is, can they put in place structural reforms? Is there any room for fiscal policy? How much more could the ECB do in the event of a more significant slowing? And that is one of the reasons why I've been advocating we shouldn't be raising rates in the United States. The European issue and global growth generally is something we're watching very carefully. So all those things you said are valid. They're issues I'm watching carefully.
Speaking of...
This is why, by the way, resolving trade and trade uncertainties, it's important in the United States. It's very critical to Europe. And that trade is a very significant element of, for example, of the German economy. It's important to the United States. It's much more important to the German economy. And so I think some progress we can make to resolve or at least clarify some of these trade uncertainties may also help in all this.
The German economy is what? 50% of their economy is exports, correct?
Yeah, and a lot of them, by the way, are within Europe. And so one of the problems is, even if trade issues are resolved, if Europe overall is slow, you're still going to see weakness in Europe, in Germany, I should say. But this is a factor amidst a lot of these uncertainties that they're facing.
So speaking of efficacy of tools and whether or not you have tools that you can use effectively, the Federal Reserve is doing a big look. I mean, the theme this year, the focus is on inflation. Rob just gave us a great explanation of one of the major forces that has not just changed inflation dynamics in this country, but around the world. And the United States is not the only country. We're one of the most successful ones, actually, in getting inflation to move up. The Japanese can have, it looks like it's impossible for them to ever hit their 2% target. They're lucky if they hit 1%. In Europe, not quite as bad, but still. So what about... Is there anything the Fed can do now to boost inflation if quantitative easing and keeping rates low for so long didn't work? What are you going to do?
So you're right. We're doing this framework review. I'm very open-minded about looking at alternative ways to track the economy, track inflation. And there's been talk of what's referred to as price level targeting, nominal GDP targeting, and other approaches to this. And so we're going to have to wrestle our way through it. But I think the most important thing for us to acknowledge to ourselves is we may well be in a period, because of a lot of these structural forces, not just the cyclical pressures, but structural forces, aging demographics, technology-enabled disruption, globalization to some extent, are all having a muting effect on inflation. I think so that for starters, whatever we do with our framework, as a central banker, I need to take that into account. It may mean, in terms of the stance of policy, we need to be more patient and more cognizant of that in the years ahead. And what do I mean? Historically, if I told you several years ago we're going to run a 3% unemployment rate and U6, that broader measure of slack, was down at 7.3, that 7.3 sounds high. The pre-recession low was 7.9 for U6. If I told you we were running that tight a labor force, you would have expected to see more inflation pressures, and the Fed historically would have moved expecting inflation. Because of these structural forces, which we've been talking about, I think it's important, despite how tight the labor force is, that we're more patient, and also may tell us that the natural rate of unemployment, i.e. how tight can the labor force get without spurring inflation pressures, maybe the natural rate of unemployment is lower than we've historically been accustomed to, and we just have to take all that into account in thinking through the proper stance of monetary policy.
If it is the Fed already at neutral rate or beyond? I mean, is it possible that relative to everything that's going on right now in the world, the Fed may have already over-tightened just a bit?
Again, I think in this job, and I've learned in my old age, it's wise to be humble and to be open. What's the most important thing a leader can do? Can be open to learning. So I would have said that where we are right now, 2.25 to 2.5, based on our measures at the Dallas Fed, is in the neighborhood of neutral. But we should be open, and I need to be open to the idea that that maybe a neutral level is a little different than we thought, and it's something I'm talking to my team about, and we're talking at the FOMC table about regularly. My best judgment, though, still, Kathleen, is we're in the neighborhood of neutral, and we might even be a little bit mildly accommodated. If you told me, though, as we look 6 months from now, if you tell me growth is going to be much slower than our 2% forecast, I might tell you I ought to go back and revisit that statement I just made. Maybe the neutral rate is a little lower than I thought. If we wind up growing around 2% this year, i.e. around potential, it might tell me that we're probably in the neighborhood of neutral right now. That's still my best guess, but I'm open to change my mind, and I may need to change my mind.
Another number I'd like to touch on that came out today was consumer spending. Came in on the light side.
Yes.
The last 3 months, I think, are pretty much negative.
Yeah.
How confident are you that that's a temporary thing, and there's something else that's going to lift people to spend more money? And by the way, the U.S. CEO or North America CEO of Toyota yesterday, Jim Lentz, basically said, "Oh, thank you, Fed. You're helping us out because you know what? All those rate increases come through with a lag, and we this year feel like we're feeling the impact of rate hikes."
And he lives in
last
Dallas,
year.
by the way.
So no,
Yes.
another good guy, just like him.
Yeah.
But it seems to me that's an important statement for the Fed, and I'm sure you do ponder it.
So let's take your first question, which is about consumer spending. I'd caution everybody. First quarter numbers for 2019 are going to be a little noisy. Why? Remember, we had a government shutdown. It seems like it was years ago. We had a government shutdown, which was part of December and into January, and we saw a lot of odd things going on in terms of the jobs numbers. You saw this level U6 went like this, then went like this. It wouldn't surprise us at the Dallas Fed that it might have had some unusual impacts on consumer spending. You had lots of people that were furloughed. You had the ripple effects of that. And so I'd be careful probably not to draw too much conclusion from first quarter GDP, consumer spending, and here's why. We know the labor force is very tight. We are at or near or maybe even overshot full employment. Household sector leverage is improved dramatically over the last 10 years. That's a long-winded way of saying consumers should be in pretty good shape and has got the capacity to spend. And it wouldn't surprise me if you don't see some improvement in these numbers in the second quarter when you get beyond the noisiness of the shutdown and some of these other factors.
And what about Mr. Lentz saying that, reminding the Fed that all
No
those
doubt.
rate increases for the past couple of years are possibly still going to be showing their impact on the economy?
It's true. I mean, we've raised rates 9 times in the last 3.5 years or so, and it definitely has an effect on the economy, and it does so with a lag. Now, some of you may say, my Lord, the Fed funds rate's only a 2.25 to 2.5. Inflation, even if it's running below 2%, real rates are historically very low. But I got to tell you, home builders I talk to the car industry, others, they're very sensitive to these level of rates. And I think one of the things I'm learning from this, the economy is much more sensitive to the level of rates. And that's before getting into the fact that corporates are historically highly leveraged and we've got a historically high amount of U.S. government debt, which further intensifies the interest rate sensitivity. So what Mr. Lentz says makes sense to me.
Risks. One risk, although I guess it isn't a risk that would precipitate a downturn, but you feel so strongly about this, you wrote a special essay a couple of weeks ago about corporate debt. And how, the numbers, you can throw out a couple of numbers for our lovely listeners here, our audience, but you figure that there's a condition here that if we slow down, go into a downturn, it could amplify, it could make that worse. And so what is really the dynamic here that you're most concerned about?
So I mentioned the household sector. The good news is the household sector in the United States, which is a very critical, it's 70% of the economy, has actually net deleveraged over the last 10 years. And we've got a very tight labor market. So that sector, not perfect, and still lots of issues with groups that haven't fully participated, but at least overall that sector's in better shape. The corporate sector is more leveraged than it was 10 years ago. Non-financial corporates. The good news is the financial sector is deleveraged, but triple B debt has tripled in the last 10 years. Leveraged loans have basically doubled over the last 10 years. So what does that mean? I don't think it's a systemic risk in that the lenders are not over-leveraged, but the borrowers are more highly leveraged. What does that mean? It means that in a downturn, what companies will do is they're already in a downturn going to cut back on CapEx and hiring. If you're leveraged, you're going to do that more quickly and probably to a greater degree because you've got debt service to meet. So what I've said is the level of corporate debt is an amplifier, okay? It means that in a downturn, it might cause growth to slow even more, and I want to be cognizant of it. Certainly from a macro-prudential point of view, in particular, I want to be cognizant of it because it's a new factor that we need to take into account in the event of a slowdown.
I want to ask you about education. We're going to, a few minutes.
I'll make one other comment.
Do.
Just so you may say, why is corporate debt so much higher? One of the reasons is back to technology and technology-enabled disruption. If you have cost increases today, historically, you might have just passed them on into higher prices. Today, for many industries, they can't do it, okay, because of technology and because of disruption and globalization. So margins would erode. Now, we know margins have been improving. And so what are companies doing? We've got a lot of things that are helping them, trade, outsourcing, integrated supply chains and logistics are helping. But the other thing they're doing is they're buying back their stock because it's accretive, and they're merging. They're trying to get more scale in order to deal with this lack of pricing power. And so there's more concentration, which used to mean companies had more pricing power. In this case, it's a sign because margins are under pressure, you need more scale to make the investment and deal with this margin erosion, and that's one of the reasons we've got more debt. And I think it's important just to explain that because it's a dynamic that we see in inflation. I think we're going to see it in jobs, impact on well-educated versus those that have less than a high school education, and it's affecting corporate balance sheets.
Okay, I'm going to put my education...
And then get to education fits into it. You're about to go to.
Well, actually, I want to just... You're making me think of another question, but I do want to get to education. But so, one of the... If I were to take the other side of the what in the world is the Fed doing question, they'd say, oh, these guys, they've kept rates low too long, and the real rate is just about zero. They're going to create the worst financial excess. This guy's talking about being worried about corporate debt. Well, he sure should be. So what about that concern? And it seems to me it puts the Fed in a tough spot because, you have to worry about people reaching for yield, and it's not just in the U.S., it's around the world. At the same time, if your only tool is the interest rate and you raise it to fight that, but, you're in a tough spot. So
this is why I always like to say accommodation is not free. What's accommodation mean? So we talked about what the neutral rate is, the rate that we're neither restrictive or accommodative. If we're accommodative, which we have been for 8 or 9 years, people think, so what's the harm? The harm is you can create excesses and imbalances in financial markets, in debt, because with rates this low, it does encourage people to use debt to do mergers, share repurchase, and maybe not as much as you'd like, CapEx and other things. And so this is why there's a balance. It's not so easy to say, oh, gee, let's just become more accommodative. There's a cost to it, and you have to balance. You want maximum sustainable employment and price stability, but you also have to be aware that if you run too accommodative a stance versus for what the economy is doing, you're going to create excesses and imbalances, which may be very painful to unwind when the time comes. That's the part of the balancing that we're trying to do with the Fed. Okay. I want to ask you a big picture education question, and this is something you've written and talked a lot about, but I have to ask you a specific one because it's in the news. Rob Kaplan, you went to school in the Midwest, in Kansas, got your college degree. Jayhawks. He worked on Wall Street. Then that wasn't enough. He had to go teach at Harvard. He got an MBA at Harvard. So when you see Jayhawks, go Jayhawks. Go Jayhawks. Although my husband, Michigan State, so it's tough to, when you see this college scandal, when you see people going beyond, well, we just bought a building or endowed something and we're legacy, so
kids, our kids get in fine. But when they take it to what seems to me to a whole other level, and people say, no, Kathleen, it's been going on for years. How do you feel about that? How do you react? What do you think this means?
So I'll stay away from the political sensitivities of this and get to one of the things we are seeing, and that is rising income inequality and wealth inequality in the United States. And what all the studies we look at show, if you get a college education in this country, we're like most people in this room, or go beyond college, you may have struggles in your career, but the statistics show you're very likely to be in the workforce, and you're very likely to have a very low unemployment rate as a group. If, on the other hand, you've got a high school education or less, which is 46 million workers in this country out of a 160 million person workforce, you're very likely seeing, because of technology and to some extent globalization, your job either restructured or eliminated. And you may find a job in a very tight labor market, but you may be going from working in a call center or some other manufacturing job that got disrupted to a service sector job where your pay is lower. And the economy is not working as well for those people, which is why I've been a big advocate. We've got to improve math, science, and reading in this country. We're ranked 25th out of 35 industrialized nations. We've got to improve college readiness. But for those who may not be as able to go to college or aren't ready, we've got to dramatically beef up skills training. There's a whole slew of middle-class jobs that are going unfilled in this country. It's known as the skills gap. You've probably heard it. Maybe well in excess of 1 million jobs that are open. Half of all small businesses in this country can't find skilled workers. And we've been big advocates at the Dallas Fed of calling attention to this. And so this scandal kind of highlights the frustration. The economy is working well for some, not as well broadly. We're very conscious of this at the Fed about underrepresented groups and are they improving in terms of their participation. It's one of the reasons I've said publicly we might be willing to run this economy and the labor force a little hotter to get people into the workforce and have them stick and stay longer and get trained. But I think this scandal is symptomatic of a broader discussion about income and wealth inequality and underrepresented groups and how well is the economy working for everyone, so-called inclusive prosperity versus working well for some and not for others. And this scandal, for better or worse, unfortunately, just highlights some of these inequities and this frustration.